Well, quick check on the Asian markets. They are flying away on the back of Wall Street gains and commentary coming in from US President Donald Trump, indicating potential progress in his trade negotiations with China. And the screen is telling you that. The NIKKEI is flying away. That's up close to 1.3%. Remember, the dollar-yen actually has cooled off from around the 113.5 odd mark. So that's shown some strength. But that's really the trade setup today. No one wants to have, the trade war getting escalated. And that's precisely what's happened. You pull up the other markets, the Kospi. That's up more than 2% in today's trading session. So great going there. And the other couple of Asian markets as well had indicated a positive tick. The Straits, in fact, is up close to 0.9%. The Taiwanese index seems like it's waking up late, still to catch up. It's trading mildly in the red. But the SGX Nifty, wow, just look at that. 77 points bump up. We normally doubt the SGX Nifty, whether it will give even half those gains. But today, I think fair to say, we could get even a 50-point bump up. Not just, these trade tensions have been put on the back burner. We also have crude prices, sub $73 per barrel. So a couple of tailwinds playing out there. A start of around 50 points. That's, that is a definite possibility early this morning. But moving on then, easing some concerns about the ongoing trade tussle, President Donald Trump said that he spoke to Chinese President Xi Jinping amid concerns about escalating trade tensions between the world's two largest economies. Now, in a tweet, the president said he had a long, very good conversation with the Chinese leader. With heavy emphasis on trade, he added that those discussions are moving along nicely ahead of the planned face-to-face meetings at the G20 summit in Argentina later this month.
And that was a tweet that really made the US markets rally, because remember, the Wall Street ended on a positive note with all three indices ending with gains of over 1% each. Market extended previous session gains on optimism that US-China trade tensions could ease in the near term. The Dow, for example, gained over 260 points. The S&P 500 climbed 1%, while the Nasdaq outperformed because that one advanced almost 2%. Separately, if you look at the economic data as well, the initial US weekly jobless claims fell to 214,000 last week, while continuing claims remained at their lowest levels since 1973. Now remember, the data comes ahead of the monthly jobs report, which is set to release later tonight. In fact, CNBC's Yan Mui gets us a wrap of all the action on Wall Street.
U.S. stocks finishing near session highs, the Dow gaining 265 points, the S&P 28, and the Nasdaq up 128. U.S. auto sales higher again in October, dominated by a rise in sales of SUVs and pickup trucks. Ford reporting a nearly 7% jump in SUV sales in October, while Fiat Chrysler saw overall sales rise 16% due to higher demand for its Jeep and Ram vehicles. SUVs contributed about 35% of Ford's total U.S. sales volume in October. Meanwhile, hundreds of Google employees around the world staging walkouts today in response to the company's handling of sexual misconduct allegations. The protests come after a report alleged that Google protected executives accused of sexual misconduct. Organizers of these protests are demanding more transparency when it comes to sexual harassment in the workplace, as well as pay and opportunity equality. And U.S. online spending, it's forecast to rise nearly 15% this holiday season, and that is according to Adobe Analytics. It far outpaces the 2.5% growth they're calling for at brick-and-mortar locations. Adobe Analytics says online sales will benefit from an extra day between Cyber Monday and Christmas, which could mean an additional $284 million in sales. And that's the action from the U.S. market. Back to you in Mumbai.
Okay, so positive action on Dow as well as the Wall Street. But on that note, here is some opinion from Jonathan Garner of Morgan Stanley on the impact of easing trade tension on the emerging markets.
Because the deterioration in China-US trade relations has been a big part of the reason that the markets have done poorly this year. But actually, the other news you mentioned is a reminder that intellectual property issues, the allegations of theft, and also industrial policy, China's industrial policy, are issues of concern to the United States. So it's not just bilateral trade deficit. If it was only the bilateral trade deficit, then we would have sold for this back in April, May, when the Chinese made an offer to buy substantially more American oil and agricultural-related products. So it is a far deeper set of issues that the US is concerned with. We actually hit our EM target in the latter part of October during this global sell-off. So we've taken that target down 3 times in February, in June and in August. We haven't taken it down again. So we are now priced well below long-run average valuations on a metric like forward PE. The earnings expectations have already adjusted substantially. They're still not as low as our own base case for next year, but they've come down substantially. So the market sort of gets the problem now in that sense. The question is, can we get ourselves back to a better place?
Well, it was a mixed session across markets, across those European markets. The three big markets, the German DAX, that was a relative outperformer. And we've got some economic data as well that came yesterday. The Bank of England, it kept interest rates unchanged, leading to a surge in the sterling. So if you look at those markets, well, the FTSE ended mildly in the red, the CAC as well ended mildly in the red, but the DAX, that was the one that was relative outperformer. Let's see how those markets do today, because yesterday they hadn't really, played out any kind of this good news. All the good news started really after those markets shut.
Okay, let's take a look how the currency space is doing then. The dollar index retreats from the 16-month high as risk sentiment improves, while currencies that were hit hard by recent dollar buying soared as safe haven demand for the greenback receded. Remember, the dollar index was just very recently trading around that 96.7, 96.9 mark. Currently, it is weakened a bit to 96.3.
Okay then, and oil prices, they're under pressure with Brent crude prices falling below the $73 per barrel mark, while NYMEX as well hit its lowest level we've seen in just 7 months. Remember, we're just a few days away when sanctions on Iran come into effect. Remember that crude has already lost, around 15% in the past month, and now in fact it's moving even lower. CNBC's Dan Murphy tells us what the fallout could be.
The second phase of the US sanctions on Iran kick in next week, and that's led some analysts to suggest that November could be a month of reckoning for oil. These sanctions are a big deal because they don't just cover Iranian crude exports. They cover a wide range of energy-exposed sectors, including Iranian port operations, shipbuilders, even financial institutions and insurance firms. Since the president's decision to reinstate the sanctions back in May, the key buyers of Iranian crude have been forced to take action. Some customers across Europe and Asia were quick to act, with Japan and South Korea curbing their imports and looking for an alternative. But Iran's biggest and most consequential buyers, like China and India, have been slower to comply. S&P data shows total Iranian crude and condensate shipments in October still averaged almost 2 million barrels, meaning the administration's ambition of zero Iranian oil exports could be a long way away. The uncertainty over exactly how many Iranian barrels could come offline, who could potentially be exempt, and who's going to make up for the lost supply has rattled the market. Prices moved back above $80 USD last month. That's a 4-year high. But analysts say diminishing fears of supply losses and growing demand concerns have since pulled prices back. Now it's unclear whether or not the full impact of the sanctions is being priced in, or if this key risk event next week is going to bring some upside for oil.
Decline in exports from both Iran and Venezuela was more than offset by the increase in exports from other OPEC countries. And then at the same time, we've seen macro sentiment sour over the course of October. We've seen crude inventories, especially in the United States, start to build. Demand at $80 to $85 oil prices has started to slow. So overall, we're looking at a balance for next year that actually flips back into surplus. And so the question now is whether OPEC is going to let that happen. And we're not going to know until really that first week of December when they have their next meeting.
Okay, so the crude currently trading below the $73 a barrel mark, but it is time now for a quick break on the show. Up next, we'll get you all the cues and news you need to watch for trade this Friday morning. Stay tuned.